Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly update with Martin North from Digital Finance Analytics. How are you today, Martin?
Yeah, it's good, Alex. I'm a bit skinny today, for some reason, but we'll hang on in there.
You're on a summer diet, Martin, for that beach body, is it? Or
I don't know what it is, but it's a technical issue. But I think we can still carry on. So as long as
yes,
I'm here, that's the main thing. Even if I'm a bit skinnier than normal.
the slides are fine, I promise you guys. So what's been happening on your end, Martin? It seems like this month has absolutely flown by.
Huge, yes. It's been a big month. So much data, of course, coming out, but also now the international situation and local situation definitely bubbling up to a crisis, and more and more people talking about quantitative easing. Stress in the household sector. Are home prices really doing what people thought they were doing? I mean, there's just so much to get across. So let's get into it, shall we?
Yeah, I'll probably just the first one I just want to mention before we get into it is that repo market. And I know we've both done a lot of videos about this, but that's really the
Yeah.
topic of debate whether or not this is QE and money printing.
Well, of course, the Fed is basically saying, no, 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 it's not quantitative easing, except that, of course, the size of the balance sheet's rising, having shrunk previously. So, yeah, it is quantitative easing by yet another name. And, of course, it's the old plan A, right? Because basically before 2008, that was how they controlled rates.
Yes.
But then they did all this other stuff and then didn't need to do it. But now that they've discovered that there's still a liquidity crisis in the US, they are now having to do more repo. And in fact, the value is going up, not down. So it is remarkable.
And we'll talk about that more once we get into it. But our first slide today is good old mortgage stress. And this one continues to climb higher as well as household debt.
Yeah, so this is the standard monthly and basically mortgage stress, despite the rate cuts and despite the tax credits, is still at a record high in Australia. And that's a big concern, right? Because essentially what that says is that people are struggling. But the other piece of data here, which was new, was the household debt ratio from the RBA. So the debt to income ratio, it's now 191.1. That's as high as it's ever been, right? So essentially this tells us that we are digging a deeper and deeper debt hole for households in Australia. And despite all the weasel words about things are okay, look at this data. It's showing you that mortgage stress is high, household debt's high, and on an international basis, we're only second after Switzerland in terms of more debt than anybody else around the world from a household sector. This is a very, very worrying trend.
Yeah, and we'll get into all those reasons why when we get through the next few slides. But next up here, we do have household confidence. This fell to a new record low, I believe.
Yeah, so we do our monthly confidence index each time as well, and it's 84.2. That's as low as it's ever been ever since I've run the survey since the early 2000s. And what's interesting is that all three of our wealth segments, so those without mortgages, those with a mortgage, and those renting, all three sectors showed a fall. What's interesting is that those without a mortgage are a little bit more positive still because they are seeing some growth from the stock markets, although there are a lot of gyrations there. But if you're just somebody who's got a property and a mortgage and credit cards, and your income's flat, cost of living rising, all of that stuff, this is just more of the same old, same old. And this month, the standouts were rising fuel prices because, of course, they've been moving up quite sharply, but also now food prices. So standard stuff down the shop. And that's partly a combination of the drought, partly a combination of just prices coming through. So households are basically saying, we've got some significant issues, and therefore we're going to hunker down. We're not going to spend more. We are just, sitting on a big pile of debt, and we don't know what to do about it. And in fact, if you go to the next slide, you can actually see we're not the only ones saying this. So effectively, the ANZ Roy Morgan survey also came out with the same story. In fact, they're saying it's the lowest, for a long time. But more importantly, their longer term forward expectation indicator is now also dropping significantly. So households are saying this isn't just a short-term blip. This is a structural issue that we feel that we're facing in Australia. And so this is a very, very important set of indicators for the future economic conversation about Australia and what should be done about it.
Yeah, and a couple of points that I want to touch on there from what you said. The rising food prices, that's one of the worst nightmares. And I'd encourage everyone to watch the video I did yesterday about if we get inflation and they're having to print money at the same time and lower rates, that's the bad scenario where they're really in between a rock and a hard place. The other thing that's interesting is that household confidence for those with a mortgage, as you say, when we've seen this sharp rebound in property prices and yet consumers aren't buying it.
Yeah. Well, we'll come on to later as to whether there really has been a sharp rebound in property prices. I think the story is way more complicated than the media has been portraying more recently.
Absolutely. Business confidence also falling?
Yeah, so this is just from Westpac. Just we put the business and the consumer one together. The NAB survey that comes out each month was also pretty negative. And this is just more of the same, that businesses are finding that there are not enough customers who are actually wanting to buy their services. So they're not going to invest, they're not going to employ more people. And it's quite broad-based, but of course, retail and construction sector are particularly under pressure at the moment, as we know. But a lot of the service sector as well, and pretty much nationally. So this is a real concern now, because basically we've got households going off the boil, we've got the business sector going off the boil, which means that the only thing that's supporting the economy is an international iron ore price, which we'll come on to in a second, and government investment in infrastructure. This is not a good story about the future of the economy.
Yeah, and as central banks pull that lever and lower interest rates, which we've seen a number of times recently, it's a more direct effect on households if the banks pass it along, but they haven't even been passing it along in full. But for businesses, it's a different story. That doesn't just increase their cash flow each month. That people still have to go out and spend more, and that's harder to get business and the actual economy going.
Well, yeah, so my SME surveys are absolutely saying that many businesses are just not seeing demand from consumers or demand from, their other customers for their services. And, wherever I look, I just see more of it. And again, we've had more closures in the retail sector in the local community down here. We've lost another shop, another closing down sale. That's 3 in 3 months. That's remarkable.
Yeah. Okay, next up here, we've got construction.
Yeah, so this is just the retail sales, we've said is going down and going backwards, but also the dwelling commencements is still pretty crook. There was a very slight uptick in unit construction last month, but the trend is clearly down. And in fact, all of the forward indicators in terms of forward building approvals and all of those things look pretty weak. And as we'll come on to in a second, the funding for new construction is also way off too. So the construction sector, that's 1 million plus people employed directly in that sector, is under huge pressure. And we're already seeing some job losses. In some cases, some people are saying 20 to 25% of jobs are actually under threat or have already disappeared. And so this is one of the reasons why we think the employment rate will probably tick up again in the next 2 to 3 months.
Do you have any more data about that sharp uptick, Martin, in units? Is that from anything in particular, any cities that you know of more than others? Or
yeah, so there's still quite a lot going on in Canberra, and there's still some up in Queensland as well, particularly the Gold Coast. So there's a few big projects still running there. There isn't much sign of life, though, that I'm seeing in Melbourne or Sydney yet, but that may change. Of course, that's in Melbourne and Sydney where you've got the main problems with poor quality construction and the risks relating to certification. So I suspect that that's one of the reasons why momentum is a bit lower in those areas.
Fantastic. So trade balance eased a little bit. This is something that we've spoken about in a lot of detail, that iron ore prices were probably going to come off.
Yeah, so as predicted, the iron ore price come back to sort of 91. It was 120 US at one stage. And the trade balance this month, last in August, was up plus 5.9 billion, which is not bad, but it was down from the 7 something the previous month. But what's again is interesting is that we're very reliant on that high iron ore price. Imports are also under pressure because basically as the economy is slowing, less companies want to import stuff. So it's not a completely good story here. And of course, the question ahead is what's going to happen with the iron ore price if China continues to come off the boil, as is quite likely, I think. Then their demand for iron ore could well come off. We also know that internationally there are other producers now providing more supply of iron ore. And that suggests that we could well see more pressure on the trade balance ahead. Now, we've been very lucky. We've had this, this effectively seagull bonus of very high iron ore prices for a quarter or a half a year, but I'm not sure it's going to be there ahead.
I think that is one thing we've got in our favour, though. A lot of countries around the world would kill for a surplus at the moment.
Well, that is absolutely right. And, you look around the world, there aren't many who can claim this. But again, you need to sort of drill down into what's creating it. It's not anything to do with, great management of the economy here in Australia. We're just lucky because we happen to be shipping out raw iron ore at high prices.
Yeah. Okay, so new lending flows are higher.
Yeah, so this came out yesterday from the ABS, and this is looking at the new flows. In other words, loans being written over the month of August, and it was interesting that there's been a significant peak. Although, if you look at owner-occupied new builds, they're down 1.1% compared with last time. This is on a 3-month rolling basis, whereas owner-occupied refinancing was up 2.1%, investment refinancing was up 1.9%. And owner-occupied purchase of new properties was up 3.3. So there are some interesting signs. But if you look closely at the data, it looks to me as though there was a bit of a peak in June and July. That was after the election. Then we had the rate cuts. But it looks to me as though it's perhaps easing off a little compared with previously. So I'm not sure that this is going to continue the momentum that some people were hoping. And the fact of the matter is, if you look at the types of segments that are buying, there's a little bit of an uptick in first-time buyers, but not dramatic really. A little bit of movement from investors, but foreign buyers are still off the radar. And all of the intelligence that I'm getting is that foreign buyers are not coming back anytime soon. So therefore, the chances of credit continuing to grow in terms of new flows is, marginal at best. But remember, this is then looking at new flows, right? What you have also to do is to take account of people who are repaying their loans. And that's why, if we go to the next slide, you can see the other side of the equation, which is that total credit growth was down to 3.1, which is the lowest it's been forever.
Yeah, and one thing I just wanted to add here was when we were in Brisbane and we were talking to the guys at ANZ Bullion, they deal with a lot of boomers who are worried about what may be ahead, and they're going into a little bit of gold and whatnot. But one of the things they're doing is getting rid of a couple of their investment properties and buying the best possible family home they can for the tax benefits and whatnot. So that might be where we see a lot of that refinancing, I think, at that demographic at least.
Well, I think the refinancing is driven by two things. One is that. The other is, of course, that the rate cuts have meant that for some borrowers, you can actually move to a new, cheaper loan, and all the banks are, desperate to write low-risk credit. So the refinancing market is very, very hot, and that's where a lot of the momentum is. But of course, refinancing just moves the deck checks around in the banking system. It doesn't increase the amount of credit in the system, right? Firstly. Secondly, if you're refinancing to a new, cheaper loan, and you can, get 50 basis points, 75 basis points off where you were previously, that is squeezing bank margin. Mm-hmm. And so I'll be interested to see in the reporting season ahead to what extent bank margins are continuing to be compressed by the Reserve Bank rate cuts, the cuts in the deposit rates to try and offset it, but also now this competition for cheap refinancing. I think bank margins are going to be under pressure. And interestingly, we saw that there was an international report that said 9 out of 10 international fund managers have now stopped investing in the Australian banks.
Yeah, and the Australian banks are nowhere near as much trouble as the European banks. But it's a bit of a glimpse into the future where they've had low rates and compressed margins for some time now, and the economy is slowing. This is what happens to the banks. They slowly crumble because of the fractional reserves and all the derivatives they've got. They don't have enough liquidity to shore up their books.
Well, that's right. And in fact, the ECB published the stress tests on the European banks this last week, and they made the point that whilst banks can survive a short, sharp problem, the sort of compression that we're seeing and the likelihood of a longer term crisis where liquidity dries up is what they're really worried about, because within 6 months, a number of the European banks would actually get into severe difficulty. So the banking system in Europe is absolutely under stress. And as you say, it's a forward indicator of what we could have here if, in fact, we follow the model of more QE and lower interest rates, which I fear is perhaps on the cards.
Yeah, and the fact they got rid of the 7% benchmark assessment rate is kind of saying that rates are going to be lower for longer, and Philip Lowe said this as well. So it's kind of saying that banks are never going to be as profitable as they were.
Well, it's hard to see how they will. Now, what's happened in Europe, and again, the ECB published the BIS published an interesting report, which said banks are doing 4 things. Firstly, what they're doing is they're investing more in speculative operations like derivatives, because you can potentially make a more of a margin there rather than lending. So that's the first trade-off. And by the way, derivatives in Australia spiked in the last quarter. So there's something going on here potentially. The second is that the European banks are actually not wanting to foreclose on households or businesses that are in difficulty. So they just sort of keep them going. They call them zombie firms and zombie households, right?
Yeah.
The third is that they're less likely to lend to new businesses in particular, because it's just not economic. And then lastly, there's a floor below which they cannot actually take savings rates, simply because depositors will just take their cash out. So the banks are absolutely under pressure. And all of those things I think we should be very conscious of, because we're going to see some of this here, I think.
Yeah, and I should probably preface my statement by saying they're never going to be as profitable in the future by lending mortgages and business. But if they go down that path of derivatives and gambling and they get QE and they get free money, then maybe they are going to be profitable.
Yeah, and this is the point, right? So the QE story is about supporting the banking system, right? It's not actually about supporting the real economy directly, and it's not about supporting businesses and consumers. And that is the critical point, which we'll come on to perhaps in a couple of slides.
Fantastic. Yeah. So, CoreLogic, you did a fantastic interview, and I think Peter Switzer might have stolen your guest or had a similar guest I saw as well.
Yeah, so this is very interesting. So firstly, the data from CoreLogic, this is based on their hedonic index and the other indices that they run. They're basically saying that there's been a significant rise in home prices in the last quarter, over the September quarter, with significant prices at the top end in Sydney and Melbourne, and in fact everywhere but maybe Darwin, Adelaide, and Perth. But the interesting question is that the true story and the right story and the complete story, right? Because I had a conversation with the chief economist at the REA, who have very good data, and in fact, they acquired an index themselves quite recently, and they're saying, and this is precisely what Peter also covered on his show, is that actually, yeah, there's a little bit of momentum at the top end of the market in Sydney and Melbourne, and so so Vaucluse and places like that, they're up a lot, but if you look more broadly across the total markets of Sydney and Melbourne, in fact, there's no recovery at all so far overall, on an aggregate basis. So in a way, what REA is saying is, well, maybe the CoreLogic, lens is not complete. And I think it could be explained by, one, very low volumes of transactions, and particularly skewed towards the top end. Secondly, only about 2/3 of prices are actually reported by real estate agencies, and they tend to report the ones that actually are positive rather than not. And thirdly, the auction clearance volumes are also extremely high, but the absolute volume is very low. So it could well be that some of this is noise in the index simply because of very low volumes. CoreLogic hasn't really come out and explained any of this or debated with REA, but I think it's really interesting that the organization who has the biggest flow of data on what's going on in the market from a real estate perspective is actually saying, so far, overall, there's no improvement in Sydney and Melbourne home prices over the last quarter.
And was that surprising for a real estate company to be that honest, or do they not really benefit either way if housing prices are going up or down?
Well, in fact, they said that they don't really benefit if prices go up or prices go down, that they're interested in volume, right? And if prices are actually going down, then potentially more people may well want to look. But if prices are going up, then they might want to look for different reasons. So in a way, they don't really care whether they go up or down. But what they do have is this flow of information coming in from the real estate agents, who have to post information into the REA systems, or realestate.com.au actually, as part of the settlement process and as part of the the deal with them. So they've got this big flow of information. It'll be interesting. It may well be it's a delay and we see some uplifts later. But remember that the CoreLogic index is also flowing into places like the ABS and other places too. So in a way, if it is that CoreLogic is a bit optimistic as to what's going on, that's a big deal, because the media keeps reporting it, and they don't seem to be reporting the REA alternative, although now it's come out on the DFA channel first, and now Peter's been talking about it. So maybe they'll be getting a bit more coverage as to say, well, maybe there's an alternative story that's worth telling. And by the way, the falls are in units compared with houses. They're on the outer urban fringe of the cities, yes. And of course in the west. And I see all that in my data. So I've not been seeing these price recoveries in my data since since May, June. So it may well be that there's a more complex story about the movement in home prices than what the media wants to portray.
Yeah, it was refreshing to hear that from REA anyway. So
I agree.
your scenarios, Martin, any changes here?
Well, just really to say that, and to remind everybody, because everybody says, oh, you're saying prices are going to drop 40%. No, it's one of the scenarios. What I've actually said is that, maybe the RBA, now it's getting more sensible in terms of understanding what's going on. Maybe there will be enough of a stimulus to be able to support prices a little, though I'm still saying 3 to 5 or 5 to 8 over 2 years. But the international situation and the risk in the system are pretty remarkably high, and therefore I'm still holding my my negative view over the next couple of years. I think that 2020 is going to be a critical year, and let's see what happens both locally and internationally. And at the moment, the scenarios look pretty right on. And if you take the middle view, I'm talking about a significant price drop across the markets in Sydney and Melbourne.
And wrapping up here, the repo markets, a lot of people starting to now talk about QE in Australia. And this was something that was conspiracy a few years ago when we started to speak about negative interest rates in QE. They'd be coming to Australia. People still laugh at my posts on Facebook when I talk about this stuff, but more and more people are talking about it.
Well, look, the RBA cut earlier in the month, and there is little leeway now for them to cut further because effectively, remember, the banks only passed on a proportion of the last rate cut, so it's had very little impact. The fact is that quantitative easing is an alternative strategy to try and actually help the economy. But actually think about Japan, think about the US, think about Europe, where they've been at this for 10 years plus. It hasn't worked. All we've done is we've moved the problem down the road, and essentially we may have supported the banking system, but we haven't supported the real economy. And that's the problem. So, and if you look at the two sides of the arguments, there were a number of senior bankers from places like Netherlands and ECB who came out and said, look, the fact of the matter is quantitative easing in Europe is not working. The negative rates and everything else is actually killing the economy. And in fact, it's time to reverse course right against what the ECB was actually saying, because the ECB is talking about doing more, right?
Yeah.
And then Philip Lowe, in his role at the BIS, published effectively indirectly 2 reports, both of which were talking about the benefits of QE and how if actually you do QE, it can help. Although he did make the point that QE has to be done as part of a concentrated focus, including fiscal as well. In other words, changing money in the economy from tax and those sorts of things. But if you look at both those reports, they all talk about protecting the financial system. They're not talking about protecting the real economy. And that's my problem with the whole QE philosophy, right? Yeah. So you can actually blow the economy up, and you can perhaps create more asset value rises, so the stock market goes up. Yes. So superficially, it all looks fine. But in the real economy, in real households and in real businesses, it actually is not helping at all. And it just keeps this perpetual situation with lower and lower rates and more inflated bank balance sheets. Yeah. Doesn't help. And so the question is this a dead end?
Yeah, and I can't encourage people enough to watch the video I did yesterday about QE and asset inflation and how this is all going to end badly. And the other option is if they start spending more and we get real inflation in the economy, that's also dangerous, like we spoke about at the start. But one of the things I found most interesting was Philip Lowe describing one of his tools as basically talking up the economy. They call it forward guidance, but it's actually now a central bank tool that you have to talk about how good things are going to be in the future and how you're going to do everything you can to keep the economy going.
Well, it's really weird when, in fact, as you say, one of the weapons is now basically propaganda. That's what it is, right? So they're telling you what they want you to know rather than what the truth is. And that's the problem I've had with the Reserve Bank for several years now, is that they're not actually being level and straightforward with us in terms of what's really going on. Now, if you look at the data they actually produce, the chart packs and those things, the story is actually very different from the one that they actually speak to in their speeches. And so they actually are using forward guidance now, but it doesn't actually really help. And basically it gets the government off the hook, because basically the government can say, well, everything's fine in the economy, despite the fact that unemployment is rising, interest rates are ultra low. And, the only lever that the government is actually preaching is effectively, let's run the household sector further and give them more debt and let's them buy more property. we got to find an alternative. We need a plan B.
Fantastic. Well, I hope everyone is sharing these sort of videos around with friends and family. And we always love it when you join us, Martin. So thanks again.
Good to talk to you.
Thanks, guys.